It is very important to get mortgage advice that you can count on. I subscribe to 3 mortgage market timing services, and I follow the news. Plus, I follow several other gurus who, are experts in what rates are going, and I do that, so I can properly advise you. Now, unlike other services, I'm not going to say what the interest rates are specifically, but I take a look at what the trends are, where they're going to go, and when to properly lock. And I just want to take a moment out to recognize Dan Rollick. He's one of the gurus that I follow. And a year ago, last November, he predicted that the 10-year bond would go down to 1.75. And yesterday, it actually did. First time ever. Now, I agree with Dan. I believe that the bond will go down a little bit lower, but not much, maybe to 1.6. And after that, it's going to stay down, but then it's going to actually go up. And so the reason I say this is rates are at historic lows right now. Take the opportunity to lock, and because rates are going to go back up. And I welcome you to today's issue of the Colorado Mortgage and Home Loan Rate Update. Today is Thursday, the 22nd of September. In the rates go up category, there isn't anything. The rates go down category. The Federal Housing Price Index was up, but it was still down. Leading indicators were down. But the big news was really the Federal Reserve meetings and the minutes from yesterday. This morning, Yahoo, they had a headline talking about, stocks opening up much lower due to the bleak Fed outlook. And I know it was down like over, right here, it's like over 340 points. I expect it to even get worse than that later through the day. Now, 3 things actually happened yesterday that's never happened before. And this is a Federal Reserve press release, and if you go to the description, down below, I will actually put a link so you can read it in its entirety. But the 3 things, first of all, Bernanke acknowledged that the Fed policy is basically futile in this environment. He can't really do anything to change what's happening, and he also guaranteed that the low rates would stay low through the middle of 2013. And the third thing is he signed President Obama's death certificate, or death sentence. What ended up happening is, if you recall, President Obama campaigned on creating a bunch of jobs. That hasn't happened. The only thing I can say is you shouldn't promise something that you can't deliver. It's the same thing as myself being a mortgage broker promising lower interest rates. I have no control over the rates, just as the weather forecaster or the weather meteorologist has no control over what the weather is going to do. They can only predict and forecast. Here's what's happening in the mortgage-backed securities today, and we had a gap up. Yesterday we had a great run, and even this morning we open up much higher. And as I've been saying before, we've been trading in a very narrow range for the last 2 to 3 months, and I've been predicting that if we could break that 102 barrier and stay above it, we'd have a great rally, and that's exactly what has happened right now. And with the bond being down to 1.75, interest rates are at their all-time lows. And here's a little bit better look, so you can see how flat it's been, and once again how the bond prices ran up high yesterday and how we actually opened much higher today. And here's the look from the last 3 months, and once again you can see that narrow range, and once again how high we've actually come. And here's like the last year, and I just want to point out something. Last November we had the best rates ever, and if you take a look at it, here we are, and then you notice, look at this big drop. I anticipate we're going to stay up here for a little while. I don't know when, and I'm not going to be able to call when the market is going to be the lowest, but I know that we cannot sustain this level up here. So I expect to have a drop down here to like a 96 or whatever, because we've actually gone up 7.5 points since we converted to the 3.5 bond. back the last 3 or 4 months. And we're just not going to be able to sustain it. So what's going to end up happening is we're going to stay here for a little while, and then we're going to drop way back down here, which means mortgage rates are going to increase. Now I want to take the opportunity to let you see exactly what happened yesterday. You can see, and let me move this over a little bit. You can see what was going on. The market was really flat. Then after the statement where Bernanke really shocked everybody, you can see how the bond market rallied and the interest rates improved. We got a bunch of positive price improvements yesterday. And one of the things I do is, as I mentioned before, I follow what's going on and I take a look at what the various lenders are doing and all that. But the important thing to really look at is just over here, the average yield spread price increase, which is basically pricing for you, has improved 0.54.8, and on a $250,000 home, that's basically almost 100 and well, $1,377.50. And that money can actually be used for closing or your closing costs. So being able to monitor who's doing what and what the changes are very important to help offset a lot of your closing costs and to get you the best deal. Here's what two of the other mortgage market timing services are recommending. Rate Alert is basically saying the same. Daily Rate Lock Advisory is saying float, 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 float. They've changed it. It was if you're closing within 7 days, go on and lock. So in summary, the Fed comes clean about employment growth to remain weak. Sorry, it's actually misspelled, for an extended period. Significant downside economic risk due to global concerns. We know about Europe and China, and all the countries are having problems. The housing market is depressed. Inflation is to remain low. It's stayed within the range that the Federal Reserve wants. Pressure's off on the commodity prices. They're coming back down. Now with the twist, Operation Twist, which is the stimulus package, what they're going to do is take and not buy the 3-year bonds and really start buying the bonds over 6 years. So they're rebalancing their balance sheet. And overall, it's really kind of a dumb idea. But the good part, it's only $40 billion, so it's really more of a token amount. And and this is what really shocked the markets yesterday. The Fed will reinvest the principals back into mortgage-backed securities, and that will help a little bit. But that really shocked them. And once again, the whole candor of Bernanke just really shocked the markets, and that's the reason we're having these fantastic rates. As I mentioned before, we're 7.5 points above last June's level. When we correct, it's going to take us down to 100. And so my recommendation right now is, if whoever your mortgage person is, go on and lock. If you find this information valuable, go on and click the like button and share it with other individuals. And once again, I'm Randy Flood. You can contact me at any time and I'll help properly advise you. And as always, wanting only the best for you, take care.